Good evening and welcome to tonight's member-only ASX Investment Opportunities in Review. Any individual reading, listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances, and realise that not all investments are appropriate for every individual. Investor Signals provides a broking account service where we incorporate our model portfolios across the ASX 2050 100 as well as US markets. We can also operate an independent portfolio focusing on specific ideas, which may include access to derivatives to enhance portfolio returns. If you'd like to know more about the service, please contact me on 1300 614 002. The technology that we're using tonight is the Investor Signals member area. If you're joining us for the first time and you're on a free trial, don't hesitate to give me a call for some further tuition or guidance on how to navigate your way around the technology. At the end of your trial, you've got access to the service for $1,320 for the year. The graph up on screen there is the Nasdaq. Continues to track above that 10-day moving average, and as long as it's doing that, we're staying on the long side of the market. We're going to shift to a little bit more of a cautious stance. If we see that reverse down, the first trigger is going to be a break below 13,845 on the index. The second trigger will be trading below that average, and I'll update you on the blog as far as the inverse ETFs to consider if we were to see that trend reverse. We're more than 2/3 of the way through December earnings in the US. We're into a heavy earnings week this week in Australia and next week. Q4 earnings in America, and if you just follow the mouse down to here, so what we're now seeing is these Q4 numbers for 2020 coming through. They are tracking pretty close to this $40 of earnings per share. So if we assume that that's repeatable in each quarter going forward throughout 2021, it gets us back to $160 of earnings per share, which is where we came from in 2018 and 2019. At that level, the index was worth 3,000 points. We're now trading at 3,900 points, so 30% higher. The reason why we're 30% higher is twofold: lower interest rates and a lot of optimism. And now that optimism is that 2022 earnings accelerate up to $50 of earnings per quarter, or $200 for the year, and the market's now trading on a multiple of that, roughly about 22 to 23 times those anticipated 2022 earnings, and that's how it's justifying this current 3,900 level in the index. So there's a lot of good news priced into the market, and we continue to just at least take some level of caution towards asset allocations, and that'll be part of what we focus on tonight. The products that we provide, you get access to our research under a subscription basis, our broking account service, or our managed fund. And again, if you'd like to talk to me about any of those services, please don't hesitate to contact 1300 614 002. Starting tonight, closer look at the Nasdaq. Let's just zoom in and have a look at what's happening here. So after 1 or 2 days of trading below the average, it's moved back above it. It's rallied from, say, 13,500 up to about 14,000 points. So let's just call it 500 points. It's rallied. It's created a new support level there of 13,845 on the index. So we watch for any reversal, first of all, back below that prior low, and then a close below the average. And at that point, start to think about BBOS, BBUS, etc. What I want to do tonight is actually take a slightly different approach. Rather than toggle through the top 100, I wanted to have a look at the stocks in the model portfolios, and at the same time obviously try to focus in on individual names that we take into account current earnings or anticipated earnings, and express which ones we have a higher conviction around. So with that, we click on model portfolios. To subscribe to these so you're getting notified whenever there's an adjustment to the portfolio, just make sure the envelope there's green rather than grey. So when it's black or grey, it's turned off. When it's green, it's on. What that'll mean is on the day that there's an adjustment to the model, you'll get a specific email highlighting that, whether that's a buy or a sell. Now, the way that I like to look at the model portfolio is often by days held, so get the least number of days to the top. So what we can see here is that within the ASX top 20, the most recent addition was Goodman Group. The stock's up marginally. As dividends come through, that'll be accumulated in this column, and that goes into the added percentage returns. And then likewise, when the stock's closed out, you'll see it reflected down in the recent closed positions. So to toggle through these, let's click on the symbol for Goodman Group, and I'll share with you some thoughts around earnings, and we'll move through these models fairly quickly. And as I mentioned earlier, don't hesitate to give me a call if you'd like to spend more time individually on the phone around understanding how this works. So Goodman Group has switched from sell conditions into buy conditions. Support there at around 17.35. The company's reaffirmed guidance for 9 to 11% of earnings growth. As you're probably aware from prior recordings, they focus on the faster growing e-commerce sort of fulfillment centres, mainly in Asia and in Australia. But double-digit earnings growth out of the property trust area is attractive. The risk here is that if interest rates in the US keep rising, and albeit they've gone from very low levels, so from looking at the 10-year Treasury yields as the benchmark, they've gone from 0.6% up to 1.2%, so still low by historical standards. But Goodman Group's trading on a pretty expensive PE, given that it's delivering high double-digit earnings growth. Well, it's expensive when you compare it to other Australian REITs, but it's certainly not expensive when you compare it to its global sort of counterparts that are in a similar area of the market. So it's comfortable being an owner of Goodman Group, just keeping in context that issue there, the backdrop towards interest rates. CSL's been a little bit out of favour as a result of the impact to blood plasma collection centres being impacted from COVID, but the correction that we've had from 340 down to 270 makes it at a buy. It switched from sell conditions, which were the red markers up the top, into buy conditions, which are the green markers at the bottom. If we think about sort of that trifecta, or the three alignment of factors that we often speak about here, which is the algorithm buy signal, the green arrow, and the strength reflected that the price is above the moving average, all good signs there. But CSL suitable for long-term investment portfolios. Aristocrat, you struggle with this given obviously the impact to casinos globally, and what that means is, are we really in a year where Aristocrat delivers its best earnings results? And the answer to that's probably not. What the market's looking at is coming out the other side of the COVID impacted period, and Aristocrat obviously leading technology provider for gaming machines, both physical machines and digital online solutions as well, which is a fast growing area of their business. So we've seen this switch from sell conditions to buy signals here at around $28, now pushing up to 33. Transurban, so the latest little leg to the sell-off there, obviously the close down in Melbourne announced on Friday. We've seen the further selling in Transurban, but the dividend appears to be stable. The outlook from the company was reasonably optimistic given obviously the backdrop we're operating in. So I'd still be inclined to think about Transurban as a high quality infrastructure buy on the dip opportunity. So comfortable there. Wesfarmers was added into the model where it switched from sell conditions to buy conditions here at $43, now pushing 55. Really like the story here with Wesfarmers as one of Australia's sort of leading e-commerce growth stories over the next 5 or 10 years. There's no doubt it is getting a little bit expensive, and it'd be nice to see a more material pullback and another algorithm buy signal before adding to that position. Coles, we like it, switched from sell conditions to buy conditions here at around $16, now pushing $18.25. I think Coles and Woolworths delivers close to double-digit earnings growth. You're getting 100% franked dividend, and roughly around 3% plus dividend yield. You could think about adding a covered call to Woolworths and Coles to help add to the returns. Newcrest, now this is one that's under algorithm buy signals, still waiting to sort of really go through this transition of a new uptrend to begin. The stock price has corrected from almost $40 down to $26. Gold's really done nothing over the last 3 to 4 months. It's mostly tracked sideways within that band of say $17.70 to $19.20 an ounce. from an Australian gold producer's standpoint, obviously selling in US dollars, converting back to a higher Aussie dollar is less attractive. The Aussie dollar's rallied from high 60s up to almost high 70s now. But Newcrest, the production numbers were good, as was most of the production. So I don't think we've seen anything yet out of the major gold producers where the last recent 6 month periods actually it's been a production issue. So it's really a factor of fairly flat gold prices and a slightly higher Aussie dollar. But I do think there is a recovery coming through in gold prices, especially if we were to see that risk off trade pick up in the Nasdaq. So another way of thinking about the tracking that Nasdaq index is if you see it break through that support level, you may want to think about increasing your exposure to gold. But I'll continue to update you there on the blog. So Newcrest is in the model portfolio. And moving on to the next one. So again, what we're looking at here is the ASX top 20 model portfolios, and I'll summarize that table again in a moment. Fortescue, we continue to like this, so it switched from sell conditions to buy conditions there at around 680, and it's one of the better performing stocks in the model portfolio. And there we are back to Goodman. So I'll click back on model portfolio. What we just did there is we started with Goodman Group, and we've moved through these in order of the table, and the table's been arranged based on the number of days held there. So another way of viewing that would be to look at them from percentage gain or percentage loss. So Newcrest is obviously the worst performing stock in the top 20 model. The best performing stock is Fortescue. If we move on and go into the top 50, now some of these stocks are going to be repeated, given that obviously the ones that are in the top 20 are also in the top 50. But I'll organise this in the same way. We've got the days held, so the least number of days at the top. So the most recent addition to the top 50 portfolio has been Xero. It was added 14 days ago, and it's roughly around the same price. So we'll start moving through these, and I'll provide comment on them as we go through. So Xero is a stock that we've liked. It is expensive, but it's delivering bankable earnings per share growth. Buying it on the dip, corrected from 160 down to 130. We're comfortable adding that into the top 50 model portfolio. Goodman Group I've already covered. Mirvac, the earnings result here, I don't think there was anything inspiring that I read in the numbers. The correction from 280 now down to 230 starts to come onto my radar as something fundamentally, but I'd probably give it a fairly wide range there. And to add that in, you come across here, go segment, and you'll just see how I'll draw the line, drag it, try that again, drag it into position. I'm just going to sit that up there. So from my point of view, I'd be looking for Mirvac to find support somewhere between that sort of 210 and 220 range. Now, if you want your charts to look exactly the same as mine, just come up to this top toolbar here. You'll see the pop-up there, Show Leon's Charts. If you turn that on again, it'll go from black to green, and your charts will start to look exactly the same as mine. And when you're toggling through them, you'll be able to see my annotations and my support lines. So Mirvac's now been added into the top 50 model portfolio, as has GPT. Lendlease is also in the model. You're probably aware from prior recordings, we like Lendlease from a long-term fundamental standpoint, but recognise the next 6 months is probably a difficult period for them earnings-wise. Qantas was removed from the model portfolio in the middle of last year, and then it's only just been added back in again at around this 430 level. You can see there I've created a little bit of width in that range. They're waiting for the turnaround there. Stocklands was added into the model portfolio just before Christmas at around this $4 level, now pushing 470. Amcor, this is still an opportunity in the market, and you see me comment on this daily on the blog. The company's confirmed earnings outlook for between 10 to 14% earnings growth, which is attractive, especially given the fairly defensive characteristics of the Amcor business and still the cost savings that come through from the Bemis acquisition. So this is one that I would take an approach of just being an accumulator of the stock at or near these levels, or you can see the downside risk in a soft market maybe just below $14, but we certainly hold Amcor in the top 50 model. Cochlear was added into the top 50 model there at around 175, pushing up to our fair value target of 205. CSL, I've already covered that. Aristocrat, we covered that earlier in the top 20, as we did with Transurban. Computer shares been added into the model and support there at around that $14 level. Wesfarmers we covered, it's one of the better performing stocks, as we have with Coles. A2 Milk, now this has been a little bit of a disaster within the model portfolios, so the stock was trending positively with higher highs and higher lows. Earnings and revenue were growing substantially, and then during COVID period there's been substantial disruptions into their distribution channels into China. We've seen 2 earnings downgrades so far, and there's a fear that obviously there's going to be a third. If we were to see that third earnings downgrade, it may be a case of where sort of the worst news is already priced in. I'll keep an eye on the upcoming earnings date for A2 Milk and highlight that to you on the blog over the next day or two. But we're willing to stick with A2 Milk as a turnaround recovery story. Sonic Healthcare we like. We think this is a defensive opportunity in the market, sort of 5 to 8% earnings growth. Own it. You could sell covered calls. If you're looking at it more from a trading standpoint, just keep an eye on this pullback back down to around this $33 level, and I'd be a buyer of it on that support. And again, I'll highlight that to you on the blog. Newcrest is in the top 50 models, support down there at 26. We've covered that. APA Group, the correction here has been a little bit deeper than I thought. We're always mindful of the cost overruns that they were having in the JV partnership project up in Northern Territory on a new gas facility there. It is a little bit out of sync with the rest of the market in that you don't get paid another dividend for APA until June. But probably the main weight here is rising US interest rates and further concerns around cost overruns on that JV project. So we're looking for clarity, probably more on the cost containment of that project, but watch this closely. It's still a high quality infrastructure asset with good growth prospects, and looking for it to find support down here and really trade back up towards that $11 mark as we get into that June dividend. Fortescue trending well at one of the better performing stocks in the models. Sydney Airport's back under buy conditions at around that 550, 560, but as with Qantas, pretty hard to get too much clarity on earnings visibility there. ASX, I like this. You've seen me talk about it on the blog almost daily at the moment. We've had the correction from $92 down to $70. Now, the earnings results that came out showed flat or slightly negative earnings for the December period, and it's not a surprise. We've been aware that obviously we had the strong volatility in the market in the prior 6 months, so it's going to be hard to beat those numbers. But at a 3 and a bit % dividend yield, fully franked, critical infrastructure, just keep an eye on this. It's might be one that we look back at in 6 months' time and recognise that sort of this sell-off that we had from 90 back down to within this $65 to $70 range is a good buying opportunity. And there we are back to zero at the moment. So just to jump back in and summarise what we did there. So we've toggled through the stocks within the top 50 model portfolio, starting with the stock that was most recently added and gone through to the stock that's been in there the longest, which is actually the ASX. So ASX is the best performing stock in the top 50 model. It's been held for 1,600 days. It's up 70% since it was added. Sorry, it's not the best performing stock. It's the one that's been in there the longest. Probably the best performing stock there would be Fortescue, up 200%. And if we can use this percentage column, you can see. So looking at the best performing stock, Fortescue, ASX, Wesfarmers, etc. So now just moving through these and onto the top 100. So we get these in days held. Let's have a look at the ones that have most recently been added to the 100 model. Atlas. So I've created the fairly wide support lines there, around between 6 and 550 there as the support level, looking for a turn there. Soul Pattinson was just recently added on that pullback to around that $26 level. Zero we've covered. Downer EDI was a recent addition to the model portfolio. This is a company that has reported earnings and they came in above expectations, and the company gave a fairly bullish outlook for earnings growth over the next really 2 to 3 years. The sale of some of their mining engineering assets could result in either a share buyback or a return of capital to shareholders. So the stock looks pretty well supported there at $5, which is the level that it was added into our top 100 model portfolio. BlueScope Steel switched to algorithm buy conditions there at around 1580. That's trending higher. Star Entertainment's now under buy signals. So we had the switch there to buy signals at around 340, pushing up to around 370. Alumina now under buy conditions there at around 160. Charter Hall under buy conditions at 13, now pushing 14. A Goodman Group we've covered. Mirvac we've covered. Aurora was a stock in some of the trading portfolios, so it's still sitting in the investment models within the top 100, given that it's switched from sell conditions to buy conditions. But in some of the trading portfolios, we've bought it at that 240 level and we've just taken profit at the moment on Aurora. But from as far as the algorithm model portfolio goes, it will stay in the model until such time as it switches from buy conditions to sell conditions, which could be, as we've seen in other examples, stocks can stay in the model portfolio for many months or even many years if the uptrend continues to evolve and a pattern of high highs and high lows develop. WiseTech switched from sell conditions into buy conditions there, just below $30. Stock now trading 33. Link Administration now under buy conditions. GPT under buy. Lendlease we've covered. Qantas we've covered. Stocklands. So obviously anything that's in the top 20 or the top 50 is also going to be in the top 100. So Amcor's a holding as well. Cochlear. So we're really just moving through these now, looking for names that we haven't covered in the top 20 or the top 50, and car sales is an example of that. So this is a stock that's unique to the top 100. It's switched from sell conditions to buy conditions there at around $18, now pushing up towards that $22 level, and we like the outlook there for car sales. Altium Group under buy conditions. It's underperforming, not one of the better performing stocks in the top 100 model. Evolution, so as we've seen across most of these gold names, similar to Newcrest, we've had the correction, but we haven't really got that turn in the beginning and the new uptrend underway yet in these gold names. Domino's Pizza switched from sell conditions to buy conditions there at $72. It was added into the model. Stock now pushing up towards 100. Aristocrat we've already covered. Transurban we've covered. Cleanaway, so this is a new addition that's unique to the top 100 model, and I comment often on this on the blog. We like it. It switched from sell conditions to buy conditions initially there at $2, and now we've had another algorithm buy signal on this pullback at $2.19, now pushing $2.36. I just like the space that Cleanaway operates in, see it as fairly defensive and good vertical integration opportunities as they push further into recycling. Computershare, I find it hard to get excited about the fundamentals here for Computershare. It's received some support following Link obviously getting the takeover bid that Link later refused, or the takeover party walked away from the transaction, and Computershare got a bit of a boost off the back of that, but we're still seeing declining earnings in Computershare, which we've now seen for the last couple of years. Yes, the rate of those earning declines have slowed, and for that reason we're happy to sort of stick with this trade and continue to monitor it closely, but looking for more optimistic commentary out of the company around return to earnings growth and better cost control. REA Group's been one of the better performing stocks, switched from sell conditions to buy conditions there at 110, now pushing up to 160. You've heard me cover in prior week recordings the concerns around the PE ratios, and we're seeing that not only in the US, but the PE ratios of some of these tech companies now in Australia is getting stretched, especially where you're dealing with high quality names. So an example like REA now trading up at over 60 times multiple. Moving on from REA, Wesfarmers, we've covered that, so that's part of the top 100 model. Cube Holdings is a recent addition. It switched from sell conditions to buy conditions there at 250, now pushing 308, and we like the long-term outlook there for Cube. Coles, covered that. A2 Milk, we've already covered that as part of the top 50. AusNet Services is unique to the top 100, so support there at around that 165. Sonic Healthcare, we covered that, and I do like that, so make a note of that around that $33 level. Beach Energy had been a favoured growth name within the energy space. The recent earnings came in a little bit below market expectation, but probably worth adding this to your watch list, especially if you're a short-term trader. Keep an eye on it. A pullback to around that 150 could be a buy on the dip opportunity, but it is performing well within the model. Appen Group within the technology space switched from sell conditions to buy conditions. It's been in the model for a while, but it has had a correction following the earnings downgrade that the company had. IDP is a new addition into the top 100 model portfolio. Newcrest Mining, we've covered that. APA Group, we've covered that, so I do like the turnaround prospects there for APA. Fortescue continuing to do well. Fisher Paykel, now terrific business, above average earnings growth, but it is expensive at almost 50 times earnings. But buying this on a pullback in this environment still likely to yield a reasonable return, so we're sticking with Fisher Paykel. Sydney Airports we've covered. ResMed, another new addition to the top 100 model that we haven't covered in the 20 and 50, but ResMed's one that I've been talking about on the blog. We've had the correction from $30 down to $25. Watch the stochastic here for a turn higher. I think, give or take 50 cents or $1, we're pretty close to a level there where ResMed's likely to find support and should be a buy on the dip. The last earnings result was impressive. JB Hi-Fi continues to deliver above average earnings growth. I think earnings came in, and I'm still reading through the numbers, I think almost 80% higher than the market had, or at the same time last year. The CEO's continuing to remain optimistic as we see what consumer spending would normally be directed towards, sort of international travel being redirected to spending on home and electronic goods. Obviously the concern there is post-March, once government stimulus winds back, what does that, what kind of impact does that have on JB Hi-Fi? So we continue to monitor that. But we originally had the addition to the model portfolio there at much lower levels, and the stock's one of the better performing stocks in the model. ASX, we've covered that. Next, DC's in the model portfolio, and it's been in here for a while, so we're from much lower levels as the stocks continue to make higher highs. Buying it in at these levels, even though we had a recent signal there at $11, the stock's pushing $12.50. I still just have some concern around the fundamentals there, but purely from a technical standpoint and tracking the momentum, next DC's moving in a favourable direction. Northern Stars merged with Saracen, and I'll talk more about that on the blog. Atlas we've already covered. And so there we are, back to the beginning. So just to recap what we've done there, so again we've gone through all the current holdings that are in the ASX 100. So another way of looking at that would be in a normal week's webinar, what we would do is go to the watch list, we would go to the ASX 100, we would get these up here in percentage gains, and then we'd get them in buy, and we'd look at all the stocks under buy conditions, and then we'd move into the ones that are under sells. So just as something different tonight, what we've done is focus on the model portfolios. As a reminder, make sure that those envelopes are turned on beside the portfolios that you want to follow. And then finally, just to finish tonight, I'll just summarize some of the other models that are in here. So the all ASX ETF model, as the name would suggest, it looks at every ETF listed on the ASX and gives you a portfolio of the ones that our algorithm suggests you hold. One that we find is popular among our broking account holders is the iShares model portfolio. So if we go into this, this gives you out of all the iShares, which is BlackRock ETFs, these are the ones that our algorithms suggest that you hold. You can see some very good gains in amongst those. The US portfolios is the Dow Jones 30, and if we click on that and have a look, we can see here, so some recent additions, so Dow Group, Nike, Procter Gamble, Coca-Cola, McDonald's, 3M, Visa, United Health, Walmart, Apple is obviously one of the better performing stocks, up almost 100%. Johnson & Johnson, Caterpillar, Walmart, it's not Walgreens, I should say, Honeywell, Travelers, Boeing, Merck Group. So one of the themes that you're seeing at the moment in the US is some of these biotech companies pulling back again. So Pfizer, Merck, we quite like. You may recall from prior recordings we made good money out of that Cure ETF. But at the moment, Pfizer and Merck have corrected to a point where I think we're starting getting back to levels where they look attractive. So you may like to toggle through the US models. Or if you're wanting to focus on the Australian market, come down here, have a look at our high conviction Australian portfolio, and I'll just finish this evening by going through these names, which a lot of these are what we cover on the blog on a daily basis. So Goodman Group we like at 1750, ResMed we like on this pullback. Resolute Mining, just a more leveraged way of getting exposure to gold, so we've added a small holding of that. This is a World X Australia sort of a defensive area, growth area, large cap stocks effectively. That's performed well. And we've held that in the high conviction portfolio. Likewise, the Morningstar Moat Vector ETF, we hold that in the high conviction portfolio. You've heard me speak about our approach to the recent buy signals in these property names rather than getting over, we own Goodman Group, but rather than buying sort of all the signals that have come up, we've gravitated more towards the Van Eyck Vector Australian Property ETF as a way of just having some broad exposure there. The WDIV is a global dividend fund, takes us exposure to some of the large cap, high yielding names. Coles, we hold that in the high conviction. Aristocrat Leisure, we hold. Fisher Paykel, we hold. The SNAS, we only hold a very small, like less than sort of 1% allocation into this, and we keep it there really as a toehold to ensure that when we see the index trade below that average or break the support, that we start to build up some hedging in the portfolio. But as long as the index is tracking above that average, we keep the weighting extremely low in any of those inverse products at the moment. Cleanaway, continue to like that. I think there's a spot for that in all portfolios. Bega, you've been probably seeing me talk about that on the blog. The company's upgraded earnings outlook, so that sits in our high conviction portfolio and been one of the better recent performers. Amcor, continue to like that. We've added that into the high conviction. Car sales, we like that. It sits in the high conviction, as does CSL. Cube now sits under sell conditions, so we haven't been quick to cut that from the portfolio, but it is under review. GDX is a gold miner, so broad exposure to gold miners through the GDX ETF. iShares Global Consumer Staples is just another way of getting broad exposure. Likewise, the Global Healthcare ETF. The miners, which is broad global exposure to gold miners. Northern Star, which we've covered. Saracen's now been merged. Transurban we've covered. Sonic Healthcare, we obviously like that. A2 Milk we continue to sit on as a recovery play. APA Group makes up part of the model of the high conviction portfolio, as does ASX. Brambles, we're sticking with this for the moment. We want to see the upcoming earnings and analyse that. CIMIC Group came out with their earnings results. It was below market expectations, but the bright spot is we are seeing the balance sheet cleaned up and the prospect of a lot lower risk business model emerging over the next 2 or 3 years, and they are sort of placed in an area where they should benefit from increased infrastructure spending, especially at a government level. Gold Road Resources is a bit more of a higher leverage recovery play to gold moving higher, so we continue to hold that in the model. Lendlease we like long term. Newcrest, we've covered that. That sits in there. Ramsay we hold, and TPG we hold in the model portfolio. So what we've done there, Wesfarmers, we hold that. And there we are, back to Goodman. So what I've done there is gone into the portfolio, gone down, had a look at high conviction, make sure the envelope's green turned on, and following tonight's webinar, if you want to spend more time having a look through those, you can either follow those models yourself, so get the rebalancing instructions emailed through to you, or if you want, you can open a broking account or our managed fund where we can help automate that process for you. So if you'd like to know more about those services, please don't hesitate to give me a call on 1300 614 002. Thank you for listening in to tonight, and just as a reminder, keep an eye on that Nasdaq. I'll draw your attention to any break below that support on the blog.